As I'm sure many of you know, Brookfield Corporation is the largest position in my portfolio by far, and the company just reported its fourth quarter and year-end results for 2024. So in today's video, I want to run through the results and give you guys my updated opinion on this business. So with that being said, let's just hop right into the video and go through the highlights from the quarter. So right here to start off the video, this says, our asset management business had inflows of over $135 billion. Our wealth solutions business is now firmly established as a top-tier annuity provider in the US, and our operating businesses continue to generate high quality and stable cash flows. We expect the positive momentum in each of our businesses to continue this year. Our access to scale capital remains strong, and with transition activity expected to pick up throughout 2025, we are well positioned to continue to generate strong growth in our cash flows and intrinsic value. Distributable earnings before realizations increased by 24% and 15% on a per share basis compared to the prior year periods. Now, right away, this is very good to see, because if you have been following my Brookfield investment and my videos on my channel for some time, you know that Brookfield has been seeing slower growth over the past 3 quarters, and what I have been waiting for is for the growth to distributable earnings to start accelerating in line with the company's 5-year targets of over 20% annual growth. So seeing distributable earnings grow by 24% year over year for the fourth quarter is exactly what I was looking for. And it's actually above my own expectations, but this just shows that Brookfield is executing and they're actually working towards their 5-year guidance now. So let's head back over to the screenshot, and here we can see that distributable earnings before realizations came in at about 1.5 billion versus 1.2 billion last year, and for the full year, they were about 4.9 billion now. Per Brookfield share, this means that distributable earnings before realizations in the quarter was 94 cents and $3.07 for the year. Now, total distributable earnings, including realizations on investments, was 1.6 billion or $1 per share, and 6.3 billion for the year, or about $4 per share. What I really like to focus on is the distributable earnings before realizations, because realizations are when Brookfield sells off an asset and realizes gains on it. It's a much more volatile source of earnings and it spikes up and down dramatically. So I like to focus on what is the actual business's operations producing. But let's move on. All right, now this next screenshot is the distributable earnings. And just like with every quarter, what I like to do is highlight the distributable earnings before realizations or asset sales. Again, this is kind of the reflection of the business's operations growing. And we can see that year over year, they did grow quite well. So the actual business of Brookfield is growing. And then when we also add in the gains from investments, we can see that distributable earnings came in at 6.3 billion. So overall, Brookfield is continuing to grow very strong. All right, now this next screenshot shows us Brookfield Corporation's distributable earnings based on the investment segment. So right here, we can see that the asset management business produced $700 million of distributable earnings in the 3 months and about $2.65 billion over the past year. It's also doing about $2.55 billion of annualized earnings now. The wealth solutions business saw $421 million of distributable earnings versus $253 million last year. This is significant growth on a year-over-year basis, and it's great to see that the insurance business is continuing to grow strong. For the full year, the wealth solutions business did $1.35 billion in earnings versus $740 million last year, so they almost doubled. They increased by 80 to 90% year over year. And on an annualized basis, they're now doing $1.56 billion in earnings going forward. BEP did $107 million, which is basically flat year over year. Same with BIP, BBU, and Brookfield Property Group actually saw a pretty decent growth to distributable earnings for this year. Overall, the operating businesses saw $562 million in distributable earnings for the quarter, and going forward, they are now doing $1.5 billion of distributable earnings. So once again, the major growth drivers for BN are the asset management business and the wealth solutions or insurance business. On an annualized basis, Brookfield Corporation is doing about $4.7 billion in distributable earnings before realizations. And it looks like they also had realized carried interest of $400 million here and a gain on an investment of $1 billion, which is how they got $6.3 billion of total distributable earnings for the quarter. I know that this may all sound confusing because there is a lot of business segments, but this is how Brookfield's business is shaping up today. All right, now this next screenshot is the table of all of Brookfield Corporation's different assets that it owns. So as of December 31st, 2024, Brookfield Corporation's ownership of BAM came in at $63.7 billion. And this is now fully listed on the stock market, by the way. And BN can now sell these shares whenever it wants to because these shares are fully liquid. So it's now extremely easy to track BN's ownership value of BAM because it's all in the public stock market. Brookfield also has accumulated unrealized carried interest of 7 billion, direct investments of 11.3 billion. Their insurance business is worth about 23.4 billion. Their BEP shares are worth 7 billion, BIP is worth 6.7 billion, BBU is 2 billion, and then Brookfield Property Group is worth about $25.6 billion on the balance sheet today. So overall, the operating businesses are worth about 41 billion. So in total, Brookfield has about $174 billion of assets on the balance sheet, and the actual debt that BN is responsible for is only $18.6 billion, which means that their net asset value is $155.8 billion now, or about $97.24 US per share. So Brookfield Corporation is still selling well below their estimated net asset value of the business, and this is why they are continuing to buy back shares. Additionally, their annualized cash flow of all of their different businesses and investments is now $5.6 billion, and this is continuing to grow. All right, now let's talk about their carried interest. And this next screenshot specifically talks about Brookfield Corporation's annualized target carried interest now. And here they say, target carried interest reflects our estimate of the carried interest earned on a straight line basis over the life of a fund, assuming the target returns are achieved. Basically, what Brookfield is doing here is they're taking their total target carried interest that they're expecting over the life of all of their funds, and then they're annualizing that back to today. And the reason they do this is because, again, their carried interest is very volatile. Some years they have a lot of carried interest, and then in other years they don't have a lot. So what they're doing is they're just annualizing what they expect to produce over the life of their funds. And right now, after all costs and after all fees and after all taxes, they're expecting about $4 billion in annual realized carried interest going forward. So if you want to think about this on a per year basis, they have about $4 billion of extra earnings that they are going to realize on their carried interest. Now, I know that this is all confusing once again, so we are going to talk about carried interest a little bit later on in this video. So let's move on now to Bruce Flatt's shareholder letter, which I always love going through, and I would strongly recommend everyone go and read the Brookfield Corporation 2024 shareholder letter. It is a masterclass on investing. I can't cover everything in the video, and by not reading this yourself, you are missing out on great information on just investing in general, because Bruce likes to talk a lot about just regular investing concepts and how investors should think about intrinsic value. So go and read it, but here are the highlights from the shareholder letter that are directly related to Brookfield's business. So this says, we also accelerated share buybacks and repurchased approximately $1 billion worth of common shares in 2024. That has continued in 2025, adding further to the intrinsic value per share of the company. To date, this year, we repurchased another $200 million worth of shares, and as a result of the repurchases in the last 12 months, you own 1.5% more of all of the assets we own without investing any additional capital. So this is Bruce basically saying that through share buybacks and reducing the overall share count, the existing shareholders end up with more of the company's assets without investing any more of their additional capital, which is great. Further down, he writes, our intrinsic value in 2024 increased by 19%, our share price by 55%. Now, what I like about this is he is very clearly telling investors how much he thinks the actual intrinsic value of the business grew versus the share price. And you can clearly see that the share price grew significantly faster than the intrinsic value of the business. And these two things cannot have a mismatch like this forever. So I am not expecting Brookfield's shares to go up another 55% in 2025, because they did grow at a much more rapid pace than the underlying business. Then Bruce Flatt writes, the intrinsic value of each share increased by $15 in 2024 at our best estimate. The intrinsic value now backing each one of your shares is approximately $100, which was a 19% total return in 2024. So you can clearly see that Bruce Flatt believes that the intrinsic value per Brookfield share is $100 today, based on the future estimated growth and cash flow potential of the business. All right, but let's continue on through the shareholder letter. And this is where we start to finally talk about carried interest and what it actually is. So Bruce writes, carried interest is our hidden gem. Our carried interest is a large asset, and it is not well understood by most investors. It is, however, of immense value and is our hidden gem sitting in plain sight. We estimate the value of our carried interest is at $30 billion. To emphasize how solid this estimate is, over the next 10 years alone, as we sell businesses for our clients, we should generate $20 billion of cash flow from carried interest to Brookfield Corporation in the form of our share of the cash generated. Given the scale, we thought it is worthwhile to lay out for you how carried interest works and how it contributes to our cash flows and, in turn, the value of our business. Alignment is critical to our business. Our asset management business raises capital from pension plans, sovereigns, financial institutions, and private retail investors around the world with the objective of investing that capital in great assets and businesses in order to generate attractive risk-adjusted returns for them. To align our interest, we are a significant investor alongside our clients and a side-by-side partner. Further alignment is also created by us sharing in the returns or profits generated for clients above the prescribed level. This share of the profits is called carried interest. So what Bruce is saying here is that Brookfield invests alongside with its institutional clients, and Brookfield also gets a portion of the returns that they generate on their funds, or essentially a portion of the investment returns when they're investing for their clients. This is called carried interest. And this is why throughout the video, I try to refer to carried interest as just investment gains, because that's essentially what it is. Carried interest is Brookfield Corporation's share of the profits that they invest for their clients. That's really all it is. And I really don't know why they use the carried interest terms. I actually think that they could simplify this further, but that's what it is. Now, heading back to the shareholder letter, Bruce writes, put simply, carried interest is our share of the profits realized on an entire fund. That is what it is. Subject to that fund exceeding a minimum target return for clients. If we meet fund expectations, we get 20% of the profits. If we earn nothing for our investors, we get nothing. The life cycle of carried interest starts with the raising of client capital for a dedicated strategy. With the growth of our asset management franchise over the years, we now manage $240 billion of capital that is eligible to earn carried interest. This figure has increased at an annual rate of 15% over the past 5 years, and we expect that to continue as we scale significantly going forward. So Brookfield today has a total of $240 billion of client capital that is eligible for Brookfield Corporation to receive carried interest, or again, investment gains on. That's all this is, okay? That's as simple as it can possibly be. That is all this is. Moving on, Bruce says, the second step is the deployment of the capital. We have established an investment track record of delivering strong returns over a long period of time, with almost all of our funds meeting or exceeding their target returns. So historically, Brookfield Corporation's different funds that it raises with its institutional clients, almost all of these have met or exceeded their returns for their customers. And this is why Brookfield is confident that going forward, they can do so once again. And when they do realize all of those investment gains, then that carried interest will come into Brookfield. So let's continue on where he writes, the last step is monetization. Selling an investment is what crystallizes a large component of the profit of an investment. As assets and businesses are sold, capital is returned to clients. Once all the original invested capital plus a minimum compound return on drawn capital has been returned to clients, we start to share in the entirety of the profits. To be clear, carried interest is only triggered with realized cash transactions. The valuations used prior to the sale have no impact on carried interest, period. So Brookfield Corporation only realizes their carried interest and gets that actual earnings when the profits or when the assets are sold off and the profits are delivered back to their clients. Brookfield only gets paid when the entire fund is distributed back to clients. That's why it's a very volatile portion of the earnings, and that's why it comes in big waves and it's not consistent every single year. So then they continue on and say, we adopt a conservative approach to the recognition of carried interest in our financial statements. We wait for the invested capital of the entire fund, as opposed to the individual deals, to be returned to clients. This conservative approach, which creates further alignment with our clients, delays the recognition towards the end of our fund's life cycle, but leads to a larger contribution when recognized. So this again is what I was just trying to explain. Brookfield Corporation does not realize their own carried interest until all of their clients have already been paid. And this creates massive alignment and actually puts their clients ahead of Brookfield Corporation. And you have to think from the client's perspective. If you know that you are going to be paid first before Brookfield Corporation even pays themselves, then you know that, well, they want to get paid. So they're obviously going to pay you. And this just further incentivizes the clients to continue investing with Brookfield. And it also puts the clients, once again, ahead of Brookfield Corporation. And this is part of the reason why Brookfield can continue to raise hundreds of billions of dollars in capital and why their investors come back and want to work with them. Continuing on, Bruce writes, therefore, much of the value creation in our investments reflected through carrying value increases or from early monetizations in a fund has yet to be recognized in our earnings. Today, we have accumulated $11.5 billion of carried interest, or $7 billion net of costs, most of which we expect to recognize into our earnings over the next 5 years. And when we took a look at Brookfield's large table of different assets, that is where the $7 billion figure came. Because currently, Brookfield is sitting on $7 billion of future gains that they will recognize over the next 5 years. And this is all just future earnings potential for the business. All right, moving on, this says, carried interest generates substantial real cash. The outlook for carried interest is significant. If we successfully execute our plans in our asset management business, we expect to receive $20 billion in cash directly paid to the corporation over the next 10 years. These cash flows will come predominantly from funds that already exist today. Further, the growth in size of each progressive vintage of funds, combined with the scale of our monetizations, should lead to even greater and more recurring carried interest over the longer term, well above our historical levels. This significant amount of incremental cash flow will allow us to deliver further value to you by either reinvesting back into the business or returning capital via opportunistically repurchasing shares. We believe that the value of our carried interest is around $30 billion, which amounts to $21 per share today. So basically what Bruce is writing here is that over the next decade, Brookfield Corporation is expecting to realize $10 billion of cash flow from carried interest. Then he's also saying that as Brookfield continues to ramp up their clients' capital and they continue to raise more funds and deploy more capital, then their carried interest potential continues to go up and up and up. Because think about it, they now have $1 trillion of assets under management and their AUM is continuing to grow. So as their AUM grows and as their fee-bearing capital grows, then their potential returns on investments also grows. Everything is compounding in this business. So that's why he's saying that the value of the carried interest could be $30 billion, and that's what they're estimating it at today, and it's worth $21 per share. But the market seems to not want to think about carried interest at all. When I've watched other YouTubers, what they basically say about carried interest is it's fluff, it's fake, it doesn't exist, and it's just them hyping up the business. I think they're being dumb, in my opinion. I don't like to be rude to other people, but I think these other YouTubers are just being dumb. Because Brookfield Corporation has a history of realizing carried interest, and it is true future cash flow. They're literally telling you here they expect to receive $20 billion of actual cash over the next decade. And as the business continues to scale, they're expecting this number to continue scaling as well. So let's wrap up this video by talking about Brookfield Corporation's valuation today. While the business is trading for $88.4 billion in the stock market today, so if we go 88.4 billion and we divide this by the $4.9 billion in trailing 12 months distributable earnings before realizations that Brookfield just generated, then we get a price to distributable earnings of about 18 today. This is essentially Brookfield's price to free cash flow, okay? So it's basically trading for 18 times cash flows today. Now, Brookfield also just grew its distributable earnings by 24% on a year-over-year basis in the fourth quarter, and they're also expecting to grow distributable earnings by about 20 to 25% annually over the next 5 years. So when I take a look at Brookfield today, I see a high-quality business with a great management team trading for about 18 times cash flows and projecting to grow cash flows by over 20% annually over the next 5 years. And when I take a look at that, I do still think that Brookfield Corporation is trading for a discount today. I also used Stock Unlock's discounted cash flow calculator to give us some perspective on Brookfield's valuation today. So here we're projecting out the free cash flow, which is actually just the distributable earnings, at a 22% annual growth rate over the next 5 years, and Brookfield trading for a 15 price to distributable earnings. And if Brookfield can continue to grow at 22% annually over the next 5 years, then the stock could continue to compound at 16% annually, and its fair value is $77 today. Now, in my opinion, I think a price to distributable earnings of only 15 is on the pessimistic end. So I also did a discounted cash flow calculation, bumping up the price to DE to 20, which is what Brookfield's competitors or peers of Apollo and KKR trade for. They actually trade for over 22 times distributable earnings. So I think that 20 times DE is actually still kind of pessimistic for Brookfield over the next 5 years, as the business continues to prove its carried interest is real, and they prove that they can grow the business at 20% annually. So basically, if Brookfield can hit its own growth guidance and actually expand the multiple to 20, which I think is fair for the business, then the stock could continue to compound at 22.7%, and its fair value is about $103 per share, which is around what Bruce Flatt believes the fair value for the business is. Because as we saw, he thinks the fair value or intrinsic value of the shares is $100 today. So in my opinion, I do still think that Brookfield Corporation is undervalued in the stock market today, and I did buy some more shares after earnings. This morning, when I read through the earnings report, I increased my position in Brookfield Corporation, and it is still by far the largest position in my portfolio at around a 21% weighting today. So I am very bullish on Brookfield Corporation, and I think that the stock is still undervalued, and that is why I am continuing to buy it. But that's going to wrap up the video for today, everyone. I think that this is going to be a little bit longer of an earnings discussion because we dove deep into the carried interest discussion as well. But if you enjoyed this video, as always, please remember to leave a like on it. And if you want to stick around and see more Brookfield content or more stock market related content, then please consider subscribing to my channel as well. But I'm out of breath now. I gotta wrap up the video, everyone. So thank you so much for tuning in. As always, I truly do appreciate it, and I really hope to see you all again in my next video.